All right, good morning, everybody. Again, this is Brian Filkey at theLender. I want to welcome everybody to the Noni webinar, where we will be teaching you how to Noni. Appreciate all the customers that have joined us today. We look forward to sharing this with you. I can tell from some of these email addresses and IP addresses that we've got some competitors on the line, so welcome as well. We've got plenty of goodies to show, and we're happy to be able to announce that we have the exclusive on the Noni. And we want to get into a little more detail about exactly what the Noni is. So we took a bit of a questionnaire prior to for everybody that joined us that was able to fill out and ask us some questions, give us an experience level, and it looks like we have a pretty broad range of experience within non-QM in general and within the DSCR, non-owner, hard money space in particular. So we'll get into the nuances of what makes the Noni special, how it fits within the non-QM universe, and how we set that apart as our product offering. So by way of background, I am Brian Filkey. I run the non-QM initiatives here at theLender. And my background was starting on Wall Street in asset management. I traded mortgage-backed securities in New York City, moved into the lending space in the early 2010s-ish, started working in the agency business, moved into non-QM at Impact Mortgage, where we grew that platform to over $2 billion in production. I've run wholesale and correspondent divisions, created non-QM technology, proprietary AUS systems, and have created some products that you guys have seen out there in the marketplace. But what I'm really excited to talk to you guys about today is what I believe to be the best product that fills a niche that's been vacant within this space by simplifying this process of acquiring non-owner loans. So what is the Noni? And yes, it's pronounced Noni. So you can see here we've got it's non-owner, no income is what the acronym stands for. And it's designed specifically for 1 to 4 unit residential loans. And it's important as we talk about the difference between what is non-QM, what is QM, what is commercial loans, that we understand that the regulations from TRID and Reg Z and Appendix Q apply to residential loans that are consumer purpose. So by way of background, consumer purpose means owner-occupied homes, second homes, or even non-owner occupied properties where the cash out is going to be used for a consumer purpose, i.e. paying down personal credit card debt, i.e. buying a vehicle. Anything that would be utilized for a consumer purpose is now regulated by TRID. And so when we talk about our non-owner program, when we talk about the Noni, we're going to be using terms like business purpose and commercial loans, but recognize that that applies to 1 to 4 family residential. And the non-owner aspect, where you're buying a property for either the ability for home price appreciation or asset appreciation and or income, cash flow, these are business purpose loans and by definition are exempt from the TRID process. Now, what makes these especially interesting for our marketplace is that the vast majority of residential lenders have not played in the space where you're doing non-DTI based non-owner properties. This has been handled by more commercial focused lines of business, which doesn't make its way into the broker base here, as well as we've seen an influx of hard money over the last decade or so. And what this product does is it bridges the gap between a traditional hard money loan or a bridge loan into a more traditional 30-year maturity product. And what makes it so exciting for us is, unlike the commercial guys who are looking at hard money loans at 8, 9, 10, 11%, where they think 7% rates are attractive, we're able to offer, and we'll get into this later in the call, we're able to offer rates in the 5% on this product, which we believe, for those on the call who have a hard money background, we believe that this is going to really put a lot of pressure on hard money and create a wealth of opportunity for the broker base here. Because when you're talking about loans that are business purpose, we're not going to be collecting income or employment information on the loan application. There's going to be no 4506Ts required, transcripts, W-2s, or tax returns. And so the question is, well, how are we qualifying this property? And just like traditional, more large-scale commercial loans, these loans are being qualified off the cash flow from the rental income of the property. So it's extremely important that, one, we recognize this is strictly for non-owner occupied properties, where the primary purpose and the sole purpose of these properties is to have tenants, renters in that property. So where are we defining this rental income stream? Well, we're taking it either from an existing lease or from a rent survey within the appraisal, and we're comparing that to the mortgage payment, the PITIA for a full AM, or the ITIA for an interest only. And when the lease agreement or the rents exceed the mortgage payment for either the PITIA or the ITIA, what you have is a NONI. So we now have a loan that has enough cash flow being passed through from the renter to the borrower to cover that mortgage payment. So when we talk about the product, we want to be looking at the market opportunity. One of the major things when we're developing products here at theLender is we're looking at that market opportunity, because if we create the best product available, but there are 12 borrowers in the universe, it doesn't do anybody any good. So we're going to take a moment here to talk about what I think is some pretty interesting statistics as it pertains to non-owner occupied properties. And the information that you see on this screen is taken from the U.S. Census information, as well as from the IRS website. If you guys want information on some of this, how to find some of this, you can hit us up. You'll be contact information given at the end of the presentation. So what you're looking at here in the top left box here is from the 2017 national housing data from the census. And it's showing that for 1 to 4 units where the primary purpose is residential, meaning either an owner, a second home, or a non-owner property, there are 121 million properties across the United States. There are 86 million approximately 1-unit properties, and the total of the 1 to 4 units is 94 million. When we look at the next column for non-owner, when we talk about what's the percentage of all these homes that we see here that are actually available to be targeted by this NONI product, it's the last line there under the non-owner column, which is 23,916,000, representing approximately 25% or 1 in 4 of the 1 to 4 unit properties in the United States. When we look at the post-crisis 2006 to 2016 household formation growth, the actual household formation growth for homeowners, those who have purchased a property and are residing within that property, actually declined by 1% over that period as the access to credit post-crisis dwindled significantly. Importantly, though, it created a major opportunity within the renter landscape, and you can see that the household formation growth for renters actually grew by 25% over that period. When we look at the investor statistics of those properties, of the 24 approximately million properties that are non-owner occupied, now the question becomes, how many of these are owned by large institutional players like the Blackstones of the world and the other large funds that came in and bought up large swaths of the residential universe? And I think you'll be surprised to find that individual investors in a 1-unit property actually represent just north of 75% of the landlords in that 24 million non-owner 1 to 4 unit properties. And for 2 to 4 units, it's actually a little bit closer to 80%. So you're seeing 1 out of 4 homes in America is a non-owner occupied property. And of those non-owner occupied properties, 3 out of every 4 is owned by an individual investor. If you'll go with me to the right-hand side of the page in the center statistics there, you'll see that in 2009, taxpayers filing 1040s who claimed rental income, there was 8.6 million individual filers that claimed rental income. Fast forward that 6 years later to 2015, and that number grew by 23% to 10.6 million. And that represents 7% of all 1040 filers claiming a form of rental income. In California alone, there are just over 13 million occupied units, and with 6 million of those being non-owner occupied. And you can see in the bottom section where I've targeted some of the larger states where the renters are a significant portion, you'll see that California, 43.1% of all homes in California are rented as opposed to owned. What does this mean for us and for NONI? That means that with the 7% of taxpayers filing real estate or rental income, means 1 out of every 12 taxpayers, 1 out of every 12 borrowers that our brokers and LOs who are on the phone are talking to own on average 2 units each. So think about that. 1 out of every 12 calls that you're getting is somebody who has maybe calling you for a primary or second home, but likely has 2 properties, 2 units where they are non-owner occupied properties. In California alone, we've talked about 6 million non-owner occupied units, representing 45% of all units in the state. And of that, a good friend of mine gave me some statistics that said there are 200,000 units that are currently financed in California that represent a loan balance between 600,000 and 2 million. So these are targeted borrowers that we can go after, giving them a significant interest rate reduction with an unlimited financed property access with no restriction based on LTV and cash flow. So a major opportunity. And what I want to really point out is that I believe with the majority of investors owning significantly more than 2 properties, for every guy that owns 2 properties, there's somebody that owns 15 to 20. And once you get outside that 5 to 10 range where Fannie and Freddie start to hit you or no longer allow you to do investment properties, we're talking about traditional turning to a hard money. So below is something I pulled off LinkedIn from a hard money lender that was basically bragging about the product. And if you look in the far right bottom corner, you'll see they're offering a 3-year term loan at 8.5% with a 2-year prepay. So I want you to keep that in the back of your mind, at 8.5% rate with a 2-year prepay with a 3-year term. And knowing that rate, knowing how many people are locked out from getting a Fannie Freddie loan, and seeing that this segment of the market has been underserved by residential lenders and non-QM lenders in particular. I'm sure many of you attended the local non-QM shenanigans here recently, and you saw that many people were just talking about bank statement loans. One of our regional sales managers, Mike McCarthy, came to me and he was really excited by the fact that not only is the Noni a significant product for us, but so many players are ignoring this product in the marketplace, choosing to focus instead on owner-occ homes. So with people turning to hard money and with no limitations on the number of financed properties, and our interest rates coming in nearly 300 basis points lower while allowing someone to have a 30-year term on their mortgage, we believe that the value proposition of the Noni for traditional hard money borrowers is unparalleled in the market. So we've talked about the broad definition of Noni, non-owner, no income, and we talked about the market opportunity set there. And we've shown that there's a significant portion of the U.S. residential market that would qualify for these business purpose type loans. So now let's talk about the specifics of what sets the Noni apart in the non-owner occupied universe. And one of the things we're going to get to at the end of the slide is when we talk about our pricing adjustments. But unlike our competitors, which have done a great job building sophisticated pricing models to help you be able to solve for how to calculate a rate and eligibility, we decided to go in another direction. And we figured by only offering 3 interest rates and making this as simple as possible, we would rather have you just be able to memorize so you can jump on that phone and talk to a customer with certainty without having to spend 60 seconds trying to figure out how to use the flux capacitor of the pricing engine at a competitor. So one of the major opportunities that we have here is that we have the ability to do first-time investors on this product. With the cash flow covering the market rents and allowing gift funds, we're opening up this opportunity to allow for wealth accumulation for those investors looking to accumulate wealth over time. And we've all recognized that the residential investment in residential inventory is a great way to get into that space. We've also talked about the simplified pricing adjustments, as in there are not any. No hits for cash out, no hits for units, no hits for interest only, no hits for condo, no hits for LTV. No hits if you've got all of those on the same loan. What we have is we've simplified this into creating 3 credit tiers. We've got a 680 plus FICO bucket, a 640 to 679, and a 620 to 639. So we're doing risk-based adjustments on the FICO, and we have now wrapped in an all-in-one price to make your life and the customer's life as simple as possible. Another major advantage of the Noni is we're going to $3.5 million to our max loan amount with up to $2 million cash in hand. We're going to 80% LTV, down to a 620, and we'll go down to 620 as our minimum credit score. There are no restrictions, no limits on the number of financed properties. It's always interesting to me to find people who claim to be, experts in the non-owner space, and yet they'll cap you at 4 or 5 properties. We really are qualifying off the cash flow of the property. We have skin in the game from an LTV perspective, so we do not have a limit on the number of financed properties for our borrowers. We're also offering fixed ARM and interest-only options, and we have a soft prepay alternative available. There are no reserves on this program since we are covering our debt. We're servicing our debt. In other words, our mortgage payments that we're paying are less than the rents that we're receiving. And we're qualifying this on a ratio of 1.0 or better to be a Noni. Now we've talked about the Noni. Let me give you some statistics of what makes the Noni different from some of what we'll call the others. So when we talk about qualifying rates, and earlier we talked about the difference between consumer purpose and business purpose loans, one of the major advantages to the business purpose aspect and using lease agreements is that we know, for those of you on the phone who own real estate, that every approximately 2 to 3 years, lease agreements are renegotiated. And in some towns in Texas and other of these high-growing cities, I've actually seen rents that are up 5 to 9% year over year. So we know that over the life of this interest-only period or over the ARM period of this loan, that there's a high probability that rents will be increasing. So we're qualifying based on the start rate. So you'll see that there's a lot of competitors out there who are a bit confused about the difference between consumer purpose and business purpose loans, and they're applying the consumer purpose regulations to the business purpose loans, causing them to qualify the borrower at the higher of the start rate or the fully indexed rate. When we talk about the interest only, and this is where it gets really special to the Noni, is that we're qualifying the interest only loan based on the ITIA, the interest only payment. Again, our competitors, a lot of them are using the higher of the start rate or the fully indexed rate, except now when you have an IO, they're having to qualify that payment over the remaining term. So in other words, if they have a 10-year IO on a 30-year maturity, they're using a 20-year maturity to amortize that loan, resulting in a significantly higher PITIA payment requiring significantly higher rents to cover or debt cover, even though that's not their payment. When we talk about the Noni and the sophistication level of some of our clientele, we've seen properties in coastal areas, Corona del Mar, others within the California area, where you are able to extract a premium on that property because of a view, etc. And so if we have a lease in place that supersedes or is higher than the market rent survey on the appraisal, and you can prove 2 months receipt of that higher payment, or higher lease, we will allow the higher lease to be utilized to calculate your ratio. There's also a lot of confusion out there around this no ratio floor, so to speak, or what makes the Noni a Noni. And for us, again, if you've got $2,000 in your mortgage payment and $2,000 in rents, you've got a Noni. At the others, some of them that floor is 1.15, meaning at $2,000 and $2,000, you're technically a no ratio, and your rate's probably 100 to 200 basis points higher. Again, with these margins, when you're looking at the competitors who are using the higher of the start rate or the fully indexed rate, they're going to be looking at the margin affecting that pricing because they have to compare the start rate to the fully indexed rate. So we talk about our max loan amounts on the previous slide going to $3.5 million, competitors at $2 million. We offer a 30-year fixed where a lot of our competitors do not in this space. Our unleased properties max LTV is 75%, and we will allow IO to the program max. We also do not have or cap LTVs based on units. So 2 units, 3 units, 4 units, same LTV restriction as an SFR. So let's walk through an example where I can actually give you guys a tangible, a little taste of what makes the Noni so special. So here on the left-hand side, you'll see that we've got a 5 3/4 rate ARM loan with a 6% margin. This index value of LIBOR, 2.75 approximately, a 30-year term with a 10-year IO on a $500,000 loan amount, estimating taxes at 1.25% and insurance at 0.3%. You'll see that bottom box is showing that if you had a full AM loan, the note rate payment on this loan would be $3,563.70. Now, our competitors who are using the higher of the start rate and the fully indexed rate are going to have to cover that mortgage payment with that fully indexed number of $5,064.39. And I want to pause here for a second to point out the fact that the competition is going to require rents somewhere around $5,100 to qualify at a 1.0 ratio because they're using the higher of the start rate or the fully indexed rate. So that is not the payment that our borrower is actually going to be paying. So in other words, that $3,500 payment that he's paying, they're going to pretend like it's $5,000 and require him to have $5,000 in rents. Now that same loan, using an IO, that $3,500 payment drops to $3,041.67. So you'll see there in the lender box where we're qualifying this loan scenario off the ITIA, at a 1.0, our rent needed is $3,041.67. At a competitor who is using, again, a 1.0, that same exact scenario, you're going to need an additional $2,022.72 to cover that $5,064 fully indexed rate. And on the slide previous, you'll remember that one of the main players in this space that we've all heard of requires a 1.15 ratio. And so in this example, using the Noni, a 5/1 IO needs $3,041 in rents to qualify. Our competitor for the same exact loan scenario will require $5,824 in rents. It's very important that you recognize that if you have a loan that's fully amortizing, and let's say they have $3,400 in rents in this scenario, the note rate payment on a full am is $3,563. That loan will not be a Noni. If it is flipped to an IO, that $3,400 payment or that lease agreement is now $350 higher than the ITIA payment. That same scenario flipped to an IO makes that payment an additional $1,500 too short. So the Noni is specifically designed for those sophisticated investors looking to take advantage of the tax efficiencies of an interest-only loan, and at the same time, our IO period is 120 months on this product. Another amazing feature that we've seen here within the Noni is that we allow short-term rentals via the online Airbnb, VRBO, HomeAway scenarios. Many of our competitors are not allowing this rental income. As you know, time is changing. Clearly, we've got cars driving themselves and battery-powered vehicles, but yet we're not willing to transition to a marketplace that really is designed for people to be able to purchase homes and make a much more efficient rental income stream. And actually, one of our AEs here had a loan scenario for a very nice property that, according to the lease agreement, there was a 1.01 ratio, making it still a Noni. But when we were able to get the last 12 months of the Airbnb rental income, that ratio actually jumped to a 1.6. So for those out there who have been a bit afraid of the Airbnb, what we allow on this with a 12-month period of showing that you know how to manage and your property's actually been up on Airbnb and you've actually gotten sophisticated enough to be able to handle that process. For refis, we're using leases collected throughout the year and averaging them over the 12-month period. And this can be done via either 12 months of statements, or what's really nice, if you go to the Airbnb website or other competitors to Airbnb, they'll provide you annual statements over ranges. We will just need the prior month, going back 12 months. And even if there are periods where that property is vacant, we will still utilize that income. We will just obviously average it over that 12-month period. But you'll find that in the major metropolitan areas for really nice properties, that Airbnb actually extracts significant more value for the investor, which gives us much more debt coverage in terms of our ratios that we're calculating on this. Now, if it's an instance where there's a purchase and the plan is to put it on Airbnb, we're going to be using the rents provided on the market rent schedule from the appraisal. Obviously, there's no way for us to know what the Airbnb income eventually will be on that property. We alluded to this earlier on the call where we talked about first-time investors, and we're defining that as a borrower who has not owned at least one investment property for a minimum of 12 months during the most recent 36-month period prior to loan application. We are allowing a first-time investor with a 5% LTV reduction. They must have a verifiable housing history, and that housing history must be 0 by 30 by 12. However, keep in mind that this program is not designed for first-time home buyers. So for those guys living at home with mommy and daddy who have never purchased a home before, the first-time investor will not work for them, as we are not allowing first-time home buyers. The major attraction to this product is the simplicity of it for a sophisticated investor. What we have to protect against as an industry is making sure that we don't have any reverse occupancy situations occurring. we will use our best judgment on the account executive level, and we will have additional scrutiny in the underwriting process here to make sure that we've got a good non-owner, truly investment product coming in to make sure that we are protecting the industry again and the product. So here's the coup de grace. Here's the magic of the program for the Noni. You've seen clearly how our qualification methods are much more common sense, allowing significantly lower lease agreement payments that cover still the payment that the borrower is actually making. We talked about the nuances that make our program special in terms of reserves, the loan amounts, the LTVs, but you'll see here what I believe to be the simplest rate sheet in the business. And that's where we have, if you've got a Noni and your credit score is over 680, your loan amount's $100,000 or $3.5 million. If you've got 2 units, you got 4 units, you're doing cash out, you got IO, your rate 5 3/4, whether it's purchase, rate and term, or cash out. So you can see we've got 3 rates listed here, 3 credit tiers, and the only adjustments on our rate sheet, if you're going to take our standard lock term, is if you want a 30-year fixed, or if you want to convert that 3-year hard prepay into a 1-year hard followed by a 2-year soft. So what that means for those that are not familiar, a hard prepay penalty means that you cannot, as the borrower, refi or sell that property. And for us, that's a 3-year period, so over a 36-month period. A soft prepay penalty means that you cannot refi, but you can sell the property. So we've got 2 options for you: 36 months, can't sell, can't refi, or 1 year, can't sell, can't refi, followed by 2 years of can't refi. Another thing you'll see is we do allow you to buy down the rate on our ARM product. And again, we don't allow that on the fixed product because this product is specifically designed for investors. And the expectation for us and what we've seen in the industry and over the billion that I've seen of this type of product in my career is that this is really designed for that ARM borrower, that investor that's looking to leverage and to be able to take advantage of tax efficiency. So at this point in the presentation, I would like to just say that for those of you who are been in the business for a while, who are doing these types of products at competitors, we are hiring, and I will give you guys the contact information of who you can contact for that. If you're in the hard money space, I think you're gonna see that you're gonna be losing a lot of loans this way. So again, we know we have some competitors on the call. We appreciate you guys tuning in, and we'd love to have you on the team if you think you can take this product to the next level. So we will take some questions here. I know we had some moderators going through and seeing some questions as they popped up. Let me go snag a couple of those. Give me a second. So we've got a question about, do we offer any rebates on this? So you'll see on our rate sheet, we're allowing, if you have a 3-year prepay, up to a max of 1, and that's at a 2-1 buy-up. So that'll cost you $50 in rate. I would like to point out that Mike McCarthy, our Western Division Manager, is happy to take your call if you're looking for a new employer, as well as if you don't have an AE or you haven't been doing business with theLender. We'd love to have you come be a part of what we're doing here. Also, Liz Schermerhorn's information is on here. She is our Director of Business Dev for non-QM. Feel free to hit them up, or if you have general questions about anything that we discussed on this call today, or if you are seeking employment information, hit us up at inquiries@thelender.com. We have any good questions here? See what else we got coming in. Let's see. Is there any reason to list the REO if the current property is owned in an LLC? So good question. We got a question about LLC. So when it comes to an LLC, we allow a max of 4 members in that LLC, and all members of the LLC are borrowers on the loan, and all will provide a personal guarantee on the loan. I don't know if this doesn't move it over. So it looks like we've got a pretty wide array of questions, and I know that the sophistication level and the of the people on the phone is varying degrees. I think what we're going to do is we're going to put together an FAQ and we'll distribute it out. We have recorded this, so we will send out for those. I know there were some questions about whether we would record this or not. We have recorded it, and we will be posting this up. We will also post the frequently asked questions, and we plan on doing these several more times over the coming weeks and months. So I appreciate everybody's time today. We look forward to helping you guys grow your non-owner business. Please reach out to your account executive if you are doing business with us, or if you would like to be a part of what I consider to be the best non-owner product in the space at the most innovative non-QM lender in the residential space. Please give us a call. Thank you for your time. Good luck, everybody. Hope you have a great quarter.